Thank you very much, Dr. Miller, and I'd like to thank you for having me here to talk about a subject that, to my wife's consternation, I never get tired of talking about. I'd like to thank you, the members of the Society of Skeptics and the students at Blair Academy, for coming out tonight. I can't say I sat where you sat because in 1966, Bogle Hall wasn't here. But we had our assemblies over in what's now the Timken Memorial, the Timken Library. But I understand that you all have to get to class tomorrow and you have quizzes, and so I'm going to try to get through the prepared part of my speech in about 20 or 25, 30 minutes. And I welcome questions in the meantime, which might make it run a little bit longer, but we want to try to get you out of here on time. So, first of all, what is this thing called the fair tax? The fair tax is not a pipe dream. It's a bill in Congress. It's H.R. 25 in the House. It's S. 122 in the Senate. And we have 82 sponsors in the current Congress, which is a record for since 1998 when the fair tax was first brought into Congress. Now, what's new in this Congress is that there's a vote coming up in the House Ways and Means Committee, we think within the next 60 days. Because up until then, the fair tax was bottled up in committee and we were never able to get it out. But it's because of the dedicated efforts of many volunteers. Now, what is this thing called the fair tax? The fair tax is a national retail sales tax that replaces, and I underscore the word replaces because it's not an add-on, payroll taxes and self-employment taxes. It replaces estate gift and generation skipping taxes. It replaces individual income taxes and business income taxes. Now, and last but not least, the fair tax phases out the Internal Revenue Service over a 3-year period. Now, how many of you have filed personal income taxes? Okay, I see a few of you have. How many of you have actually prepared personal income taxes? Okay, well, I'm going to ask those of you who are income tax savants to indulge me for a minute, because we're going to do a very brief overview, a bird's eye view of the personal income tax. Why? Because the personal income tax is one of the taxes that the fair tax is replacing. Okay, the personal income tax is a tax on income. The income can be from you at work, or it can be from your property, your ideas, or your investments at work. Now, investments can be interest on your savings account, they can be dividends, or they can be gains from the sale of stock. So let's say you buy a share of XYZ Corporation for $100. 5 years later, you sell that share of XYZ for $200. You make $100 on the sale of the stock, and you have to pay income tax on the $100. Now, other items, I don't think this first one applies to you yet, alimony, and hopefully it never will, but business income, less expenses, is another example of income. IRA, pension distribution, Social Security, rental income, farm income, unemployment compensation, that's all income on which you have to pay income tax. And another example is income from barter. Barter is the exchange of things or services. Let's say a lawyer charges $100 to write a will, and a doctor charges $100 to give a physical. So the lawyer and the doctor get together, and they say, we're not going to send each other a bill. Lawyer, you write me a will. Doctor, you give me a physical. So as far as the lawyer and the doctor are concerned, everything's fine. But what about Mr. Taxman? Does he think that's a good idea? Well, I think you could probably anticipate the answer. Mr. IRS comes along and says, wait a minute, Mr. Lawyer, you just received $100 worth of services from the doctor in order to write a will. Mr. Doctor, you just received $100 worth of services from the lawyer to give a physical. So each of you has to report $100 to me, Mr. Taxman, and to pay tax on the $100. Okay, so All right, sorry, I'm a little bit technically challenged. Now, so you get this big pile of money called income. Now, do you have to pay tax on the entire pile of income? No, because Congress says that a certain amount of money you need just to live on. You've got to pay rent, you've got to buy groceries and things like that. So you shouldn't have to pay income tax on income that you need in order to live. And the fair tax solves that in a different way. So the first thing you can take off or subtract from the income is something called your personal exemption. And in 2013, that's $3,900. And then you can subtract your deductions. And again, all this helps poor people, or it helps everybody, actually. And the standard deduction is one example of a deduction. That's the no questions asked deduction. And so for single taxpayers, it's $6,100. Now, I'm just giving you the overview of the income tax. Don't take this to the bank because you're going to get in trouble. The tax code is very complicated, and you're going to be angry at me if you get in trouble, and I don't want that. So this is just very general information. Okay. Now, let's say you have itemized deductions which are more than your standard deduction. You can take those deductions, but you have to prove them to the Internal Revenue Service. And examples are medical and dental expenses, state and local taxes, home mortgage interest, gifts to charity. Now, you've got this pile of income, and you take away these deductions, and you're left with what's called taxable income. How much tax do you have to pay? Well, it depends. If your taxable income is no more than $8,925, as you can see up in the upper left, you pay 10%. Now, if you earn more than that, but not quite $36,250, you pay 15% on that next bracket of income. So the idea behind the income tax is the income tax is a progressive tax because the government thinks that the more you earn, the more you're able to pay, and the more you should be paid. So the top bracket is 39.6% if you're making, as an individual, over $400,000. Now that we've seen what one of these taxes is, the fair tax replaces the income tax, personal and individual income tax. It replaces the business income tax, and it replaces your estate gift and generation skipping taxes with a national retail sales tax. No tax on business, we just tax the final retail sale to a consumer. It's on all services, there we go, all services and all new tangible property. So once tangible property is paid the tax, it becomes used property. It doesn't pay the tax again. No exceptions. We tax food, we tax clothing, we tax rent. But once and only once, and we have something called a family consumption allowance, which makes the fair tax fair to everybody, and I'll get into that later in the talk. The fair tax is revenue neutral, so it's designed to collect exactly the same amount of money for the federal government as the federal government is losing from the taxes that are being replaced. So it collects the same as with the business and individual income taxes, the payroll and self-employment taxes, estate gift and generation skipping taxes. So a couple of caveats. The fair tax is about the income side of the ledger. We think the fair tax is a better way for the government to get money. We don't change how the government spends money. And the other caveat is that the fair tax does not change state and local taxation. So if New Jersey wants to continue to have the personal gross income tax and the corporate business tax and its estate tax, it can continue to have it, but we think that New Jersey is going to conform its tax regime to the new fair tax if we get the fair tax. Finally, the fair tax has a sunset provision. Why is that? We don't want to end up with both an income tax and a consumption tax. So today we just have the income tax at the federal level. We don't have a federal sales tax. We only have that at the state level. So what happens is, if Congress fails to repeal the 16th Amendment to the Constitution in 7 years, the income tax sunsets, and then Congress has to figure out where its money is going to come from. The rate is 23% tax inclusive. Tax inclusive means the cost of a good including the tax. So in other words, if you go to Staples, you buy a pen that's marked for $1, you take it to the checkout counter, the sales slip from the cash register shows $1, and it shows of that dollar, 23 cents of that is the tax, 77 cents is that is the actual cost of the pen. Now some people think that we're being a little cagey, because if you take 23 cents as a percentage of the 77 cents, it's really 30%, and that's the way we normally express sales taxes. But look at this. Other including expressed taxes are the taxes that are being replaced. So the corporate individual income tax, the payroll tax, and the estate gift and generation skipping tax. So having told you about the income tax, why do we fair taxers think that the income tax has been a very bad idea for the past 100 years? The first reason is the income tax is something that nobody completely understands. And what makes that particularly insidious is that if you don't understand your tax code, you don't know whether or not you're in compliance with the tax code. The U.S. tax code, if you look at the statutes, the regulations, and the revenue rulings, is over 70,000 pages long. Back in 1914 or 1913, it was 400 pages long. So we just keep piling on regulation after regulation. This gargantuan nature of income tax makes it unfair in appearance and in fact, and it hides the cost of government from the consumer, which we think is a bad thing. Now, in addition to being complex, the income tax is inefficient. What do I mean by an efficient tax? An efficient tax captures as much of its tax base as possible at the least possible cost, not only to its government, but also to its citizens. The IRS acknowledges a 25% tax gap. In other words, if everybody who is supposed to pay tax paid tax, then the rest of us who do pay tax could pay 33 1/3% less tax, and the government would still collect the same amount of money it's paying today. Now, in addition to being inefficient, and in addition to being complex, the cost of the current tax system is enormous, and every economist will tell you this. The IRS budget is $13 billion a year. That's chump change. The real cost of the tax system, the 98% of the tax costs that are the part of the iceberg that's underwater, is a tax compliance cost for the rest of us who have to pay taxes. And this is estimated by the Tax Foundation to be $400 billion, or 3% of gross domestic product. Gross domestic product is the total value of goods and services produced by our country every year. Now, if you take this 3% of GDP that's being applied just to comply with our tax code, and instead utilize this to make goods and services that are more responsive to the wants and needs of consumers and more competitive in international markets, the real cost of our tax code is 6% of GDP every single year. Now, many small businesses, including my dentist, pay more money in accountant's fees and tax compliance costs than they actually pay in tax, and that's just wrong. Now, I'm going to go through this because, so in addition to being complex and inefficient, the income tax hurts economic growth. Now, why is that? That's a picture of an asteroid, and that's going to crash into the Earth in the year 2040, metaphorically. Because in the year 2040, revenues from the current taxes won't be enough to pay the debt service on the current national debt. Now, our tax code discourages savings, but we need to address this problem. And why is that? Well, let me give you one theory. Why does the government overspend and run up debt? Taxable income as a tax base is very volatile. And what that means is, in times of economic expansion, politicians tend to find ways to spend money because they think there's a lot of money there. But the problem is, in times of economic recession, when there's demand on social services, governments have a hard time cutting back. So if there's something we can do to smooth out the volatility of the tax base, it would make it much easier for us to have a responsible budget. The current tax system taxes reinvested earnings. What do I mean by that? Let's say you want to grow your business. There's two sources you can look to. You can look to the profits that you made, put them right back into the business. But with our income tax code, what happens? You pay tax on the profits before they get put into the business. But so what do American companies do? They borrow, because interest on debt is tax deductible. Now, so that's why American corporations tend to be over borrowed. It taxes exports indirectly, because if you tax a business, the tax costs that you impose on the business are passed on to the consumer in forms of higher prices. Now, European countries have something called the value-added tax, which gets abated for exports. We in the United States don't have that, so our goods, when they go overseas, pay the full freight, and they compete with European goods whose tax costs are significantly less. So, the other problem with the income tax is that corporate resources, including board meetings, are disproportionately devoted to tax planning and not to business planning. And this is actually how the fair tax got started. Three businessmen in Texas were talking about how much time they spend in board meetings talking about taxes, and they wanted to come up with a better plan. They commissioned some economists in Massachusetts, and the economists came up with the fair tax. And for individuals, income taxes tend to be biased against thrift. And a debt counseling service in its advertising recently said that 6 out of 10 American households have problems with consumer debt because the current income tax code doesn't tax consumption, it taxes production. So that's why what you tax, you get less of. So people, instead of producing, consume. Now, in addition to being complex, in addition to being inefficient, in addition to being a hindrance to economic growth, our current tax code is unfair. Now, why is it unfair? Let's look at the two most regressive taxes that we have today. And what do I mean by regressive? A regressive tax is a tax that tends to hurt people at the lower segment of the economic spectrum the most. And one of these is the payroll tax. The hamburger flipper at McDonald's pays payroll tax on his first dollar of wages, but Steve Forbes doesn't pay any payroll tax on his investment income. So that's so the payroll tax impacts people at the lower end of the economic scale. The other regressive tax are the tax costs that when you impose them on a business, the business passes those tax costs onto the consumer in the form of higher prices. And this includes food, rent, clothing. And so this impacts poor people the most. Small businesses also can't afford the fancy lobbyists on K Street that the big corporations can afford. And so they tend to get hit most hard by the business income tax. Now, having talked about why we think the income tax and the current tax code is a bad idea, why is the fair tax, in our opinion, a good idea? And it's a good idea for many of the same reasons that the income tax and the current tax code are a bad idea. First of all, the fair tax is simple. If you're an individual, you don't pay tax anymore to the federal government. You pay tax when you go to the cash register and buy something. If you're a business and you're a manufacturer, you don't pay tax because you're not selling to consumers. If you're a consumer, You fill out a 13-line form. It's simple. It's done. There's no dispute over the identity of the tax base or the timing of the taxable event. And so that's one of the reasons why it's better. The fair tax reduces the tax gap. And you'll see these Walmart and Target. Now, why do I put Walmart and Target there? Because I'm going to skip and get down to the fourth reason is that retail sales taxes tend to be collected mostly by large retailers, and so you don't have a tax evasion problem. The fair tax reduces the collection points from 155 million individual and corporate income tax returns to 20 million, so the tax collection point is much more focused. If you're going to cheat under the fair tax, you need to have a willing seller and a willing buyer. Whereas under the income tax, it's a lot easier to cheat just by filling out the form incorrectly at your own desk. And it's easier to comply with, and because of the simplicity and transparency, there's a greater perception that the fair tax is fair, and more people voluntarily comply with it. And there are controls for the garage that sells things in cash and for no tax. I want to talk about the economic response to the fair tax, and this was a study that was done by David Turk of the Beacon Hill Institute. These are year 5 numbers. Real GDP is up, domestic investment is up, capital stock goes up, employment is up, real wages are up, and yes, even though you tax consumption and what you tax you get less of, consumption is up by 1.8% by year 5, and by the time you get to year 10, it's up even more. And exports lose their 18-point disadvantage that they suffer from today. Now, here's some other cool facts. We don't have a country in the world yet that has a true fair tax system. But let's look at 7 states of the United States and look at these are states that don't have a personal income tax. And let's see how they did in terms of gaining congressional seats over the last decade. Washington gained a seat. Texas gained 4, Florida gained 2, Nevada gained 1, Alaska, Wyoming, and South Dakota didn't gain any, but they have small populations, and so maybe someday they will. And these are 2 more states that don't have a personal income tax on earned income, but they do tax dividends. And New Hampshire and Tennessee did very well. And if you'd like to read up on that, there's a great book I can recommend. It's called How Money Walks by Travis Brown. And it talks about the shift in GDP from 1995 to 2010. And this is one of my favorite fun facts, U-Haul. Now, why am I talking about U-Haul? How much does it cost to rent a 26-foot truck to go from California to Texas? And how much does it cost to rent that same U-Haul truck to go one way from Texas to California? It costs 2.7 times as much to go from California to Texas. Now, why is that? Well, and why would anybody want to go from California to Texas? California has beaches, it's got mountains, it's got 2 vibrant metropolitan centers, it's got beautiful weather. But there's one thing that Texas has that California does not have. Texas has jobs. So people will move where the jobs are. Now, we've talked about the fair tax, about complexity, about efficiency, and about economic growth. Let's talk about fairness. We've talked about the fair tax getting rid of the payroll tax, and it gets rid of the tax costs that are embedded in the price of every good you buy and every service you use. Now, in addition to that, we have something called a family consumption allowance, or a prebate, because we too, under the fair tax, have to make some allowance for people who are at the lower end of the economic spectrum. And actually, it benefits everybody. The prebate's a monthly payment from the Social Security Administration, because remember, there's no more IRS, and it goes to households whose members are lawful residents of the United States. And the purpose of it is to cancel out the tax on spending for essentials up to the poverty level. Now, what's the poverty level? This is the 2013 table. Let's look at the 2 adult household, and let's look at the 2 adult household with 2 children. Health and Human Services says that that household has to consume $31,020 in order to keep itself out of poverty. Now, if that household had to pay tax on its consumption, it would pay, if you look over to the right, $7,135 per year, or go a little further to the right, $595 per month. Now that's pretty heavy. So what the fair tax does is it reimburses that household $595 a month at the beginning of the month, so that when members of the household go to the grocery store, or when they go to the Nintendo game store, or wherever it is they go and buy stuff and pay tax, they will have been reimbursed up front ahead of time for the amount of tax. And this makes the effective tax rate very progressive. Not very progressive, but here's the family of 4. At $31,020, if that's what the household spends, the effective rate, because of the prebate, is 0. And then as you spend more, the impact of the prebate is relatively less. So that's that's how we make it fair. We don't exempt food, we don't exempt clothing. We simply give everybody a family consumption allowance at the beginning of the month, and so that way we don't have to worry about erosion of the tax base. And this is something that's near and dear to you. Tuition is not taxed because we consider tuition to be an investment in people. Big business and mom and pop shops under the fair tax are treated exactly the same, because either they sell to consumers at retail or they don't. If they don't sell to consumers at retail, there's no tax, but then Exxon doesn't get an oil depletion allowance because there's no corporate income tax against which to take that oil depletion allowance. We're coming to the end here. There's a picture of me with the coordinator of tax policy for the government of Chile. I was in Santiago a year ago, and they agreed to talk to me about the fair tax, and they have a lot of interest in it. I can't say that Chile has adopted the fair tax, but if it does, other countries are going to have to fall into line, because Chile would see its economy grow in spades. And my last slide is our fair tax organization. We're single issue. We are nonpartisan, and as a regional director, I take that very seriously. And we have a subscriber base of 350,000 people nationwide. And if anybody would like to write a term paper or a paper on taxation, I would say get in touch with Dr. Miller, and he'll put you in touch with me, and I can give you whatever information you'd like to have. So with that, I thank you very much for coming out on a weeknight. Hopefully someone, and I see there's my first question.
Yeah, all right, so a consumption tax would definitely lower the deadweight cost of the tax system, but why not adopt something like a value-added tax? I see a problem with the fair tax. What if so you mentioned you're going to tax everything, you have to equalize the system, but what if you have someone on food stamps and they're paying 23% on food, but they're also getting a deduction from food stamps? It's kind of like a double whammy. It doesn't really make sense. Why would they be paying tax on something that they get entitled to?
Okay. I hear 2 questions, and that one is you had a question about the value-added tax. A value-added tax gets you to the same arithmetical result as the fair tax, but it does it in a different way. The value-added tax puts a tax at every stage of production and distribution on the way to the final consumer. But everybody along the trail of production and consumption, in effect, pays the tax on the value that he adds, or the incremental value that he adds to the good of the service before passing it on. Yeah, the other was about the food stamps. Yes, up front, everybody pays the tax, and we don't make any bones about that. Now, the food stamps program is not going to stop because we have the fair tax, because the fair tax doesn't touch the spending side of the ledger. So, if in addition to this family consumption allowance, a family whose means are low enough so that they're worthy of assistance from the government in the form of food stamps, they will continue to get food stamps. Was that responsive to the question?
So you had to say the prebate thing we're talking about?
Yeah, the prebate and food stamps would coexist. The prebate is meant to untax everybody in the who's lawfully in the United States for consumption up to the poverty level. And it's based on household size. It's not based on income. Okay. I saw a hand up there, sir.
What's to stop people from like buying cars and stuff overseas?
What happens is this. The question is, what's to stop people from buying cars overseas? If you're an American citizen and you live overseas and you buy a car overseas, you're subject to the laws of that country. If you're an American citizen living here and you buy a car overseas, you pay that country's taxes, and it'll probably abate its value-added tax. But when you bring the car here, at the point of entry into the United States, that's when you pay the tax on the foreign good. So it's just like a foreign origin good that you buy in the store here, except you pay it when you bring it in.
So that would get rid of duty-free?
Get rid of duty-free. You'd still have, I think, up to $400 is duty-free. I think I think there'd probably have to be regulations about duty-free. But I think it's, but yeah, I think basically you tax the foreign-made good at the point of entry. Yes, ma'am.
I worked for legal services for many years, and when you talk about people who are at the poverty level, that people are actually poor in this country way above the poverty level. And a lot of the people that I worked for were in very, very serious economic straits because the poverty level has been set and hasn't been changed for a long, long time. And when you talk about havens like Texas that don't have income tax, Texas treats its poorest citizens appallingly. And so when I look at this plan that you have, the very, very poor might be okay, but the people just skating above the poverty line are going to be in serious, serious trouble. And ExxonMobil, which doesn't sell anything, except for its retail things, but you've got major corporations that don't sell retail, will be paying no taxes at all. And so I can't see how getting the money for the country to run from the people rather than from the producers of it doesn't make any sense, and it certainly doesn't seem fair.
Mm-hmm. Okay, let me answer that with 2 points. And yeah, the point is that the official poverty level is inadequate as a measure of true poverty. The tax system, whether it's an income tax or whether it's a fair tax, has to have a mechanism for aiding poor people. And we think if you look at the income tax, there are certain exemptions and there are certain deductions. The standard deduction is meant to, you could probably argue that the income tax too is inadequate in terms of sheltering people from payment of taxes.
The earned income tax credit goes a long way.
The earned income tax, okay, that's true. Let's see, what was the other point? Basically we're talking about the, okay.
Corporations. Exxon is that.
Yeah, because the point is that Exxon under the income tax code gets a number of tax favors because it can afford lobbyists in Washington. Under the fair tax, all that goes away. Now, maybe Exxon won't pay income tax, but neither will the mom and pop shop on the corner pay any income tax or pay any payroll tax. And so the bookkeeping is simplified, and then you're going to get, so we think that you're going to, under the fair tax, you're not going to get, I think, we think that the macroeconomic effect of the fair tax will outweigh some of the, it's true that people, whether they're poor or whether they're wealthy, will pay the tax up front, but the idea, whether it's an income tax or whether it's a fair tax, you're still going to have, you're still going to have some mechanism to try not to tax people at the lower end of the economic spectrum. And the study by the Beacon Hill Institute indicates that the people who benefit disproportionately from the fair tax, if you accept the premise that that consumption is that money consumed is the true test of wealth, because if you're saving money, you're deferring gratification. We think it's the people at the lower end of the income spectrum that benefit disproportionately from the fair tax. Yes, sir.
What stops the bigger companies, since there's no income tax, with the fair tax plan on buying houses from the top shop and just getting rid of them?
What stops the beer companies from buying out the mom and pop shop and getting rid of them? I don't know if there would be any difference between the incidence of that under the fair tax and the incidence of that today, because and actually the mom and pop shop would not have the same relative disadvantage vis-a-vis the big beer company, because the big beer company can have a tax department and it can pay for lobbyists, whereas the mom and pop shop right now is at the mercy of whatever the retail tax is at the retail level. So I haven't seen any study that would indicate a difference between those two. Yes, sir.
You mentioned it's nonpartisan. What's the party breakdown of the 88 sponsors?
They happen to be all ours. They're in the last Congress we had Dan Bourne from Oklahoma. Now, having said that, at the very beginning of the fair tax in 1998, there was a rule that when we had 7 or 8 sponsors, that every person who became a sponsor was expected to bring along somebody from the other party. Unfortunately, what the intelligence we have is that with the other party, the leadership has told them, don't co-sponsor the fair tax. And that's most unfortunate, because we want Democrats, because we think we have a number of arguments that we can make without being disingenuous to people on both sides of the aisle. Anybody else? Yes, sir.
What's to stop me from declaring myself a corporation and thus not paying any taxes? I could call my house, my office, my car, a company car. If B2B is not taxed, what's to stop me from doing that and avoiding all the taxes?
A couple of things. The question is, what's to stop me from making myself a corporation and buying everything tax-free? First of all, when you buy things, you're going to, people who sell to you are going to have to see what's called a registration certificate. And although there's no tax paid on sales to you from Walmart, if too many sales to you are being registered, then sales tax authorities are very adept at catching that kind of thing. Also, it happens today under today's income tax rules. People tend to take things as business deductions, and so to that extent, I think that there would be an equal incidence. The same hobby rules that apply to, similar hobby rules that apply to today's income tax also apply to the fair tax. So it's not a perfect world, it's not a perfect system, but we don't think that the incidence of evasion for that reason would be any higher than it is today, and possibly even lower. Yes, ma'am.
I still don't understand how you're going to make up the money from the big corporations who don't sell retail, who all of a sudden, these major corporations will not be paying any taxes at all. So, and they are a big part of our tax base. Where is that money going to come from if it's not going to come from the consumers, most of whom do not have anywhere near as much disposable income? I mean, I just don't see how the numbers work out.
The latest, there were two studies. There was one done by James Paterva, who was an economist at MIT back in 1995. And there was a follow-up study done in 2006 by the Beacon Hill Institute. And the result they came from was strikingly similar, even though there was a 10-year difference. The Paterva came up with 22.9, and the Beacon Hill Institute 10 years later came up with 23.82. The methodology is basically you have to look at the taxable income that's going to be replaced, and then you have to make a few adjustments to that taxable income. One is you have to make an allowance for the family consumption allowance. There's one called that actually lowers the amount of income that you have to replace, which has to do with government expenditures. And then you have to make an allowance for what we call the administrative credit, because there's no more IRS. The state sales tax authorities are the ones that impose the tax, and they get 25 basis points for their effort. Retail merchants get 25 basis points for the tax that they collect and send on to the state sales tax authorities. And then you have to look at the consumption base, and that comes from statistics of the St. Louis Federal Reserve. And the personal consumption is about it was about $9 trillion back in 2006 when the study was last done. Now, one thing I couldn't get into because it was probably a little bit too detailed was the state and local government consumption is also taxed, and there's a reason for that. So that basically, if the town of Blairstown, when it pays its fire department and its cops, it does pay tax on those wages because those are personal services, and it pays tax on the stuff it buys. And the reason for that is if you didn't do that, there would never be privatization of government services. So that's about 18% of the tax base. And then the federal government pays tax on its own consumption, but the federal government also, it takes in on one side of the ledger and then it pays on the other side of the ledger, so that's already been taken into consideration. So if you look at those two studies, it's calculated to be revenue neutral, and it doesn't replace excise taxes and customs duties, and there's a few other federal taxes that don't get replaced. It's just the subtitle A, B, and C taxes of the Internal Revenue Code. Okay. Yes, sir. If
our current tax system is so flawed, why are people so reluctant to adopt a fair tax system, like California or Chile?
Sure. It's yeah. The question was, if our current tax system is so flawed, why are people reluctant to change? I think there's a natural tendency to stay with the devil you know rather than to go into something that's unknown. So there's a certain amount of inertia in the human psyche that makes us stay with what we know. So when they talk about tax reform, we stay with, people tend to tinker around the edges with the Internal Revenue Code. And yeah, the example, 1986, Ronald Reagan wanted tax simplification. And he got tax simplification for a few years, but now the Internal Revenue Code is more complex than it ever was. So I can't give you a better answer than that. Anything else? Anybody else? Yes, sir.
What about Blair? Will our tuition go up as we pass on the costs of 23% on new carpet, paint, projectors, screens? Are we subject to that 23% as well?
I'm glad you asked that question. The question is, what about Blair? Would our tuition go up? And actually, your tuition would go down, and here's why. First of all, you don't pay tax on your tuition to Blair. Secondly, Blair's gets what we call a qualification certificate. It's a nonprofit organization, very much like nonprofits today that don't pay tax. So that means that Blair, when it goes out and let's say it buys a maintenance truck, it presents its qualification certificate to the vendor, and the vendor abates the tax when it sells that truck to Blair. So that now if Blair sells books in order to make a profit, in order to raise money for Blair, then probably there would be tax on the books. But the basic operation of Blair Academy would operate in a tax-free environment, much the way it does today, and that's tax abatement that could be passed on to you, the students.
Okay. Thank you very much.